If you're a trader, you've seen them all over your charts, right? Fair value gaps, or FVGs. They look so promising, but how many times have you watched price just blast right through one? It's incredibly frustrating. Well, in this explainer, we're going to pull back the curtain and show you how to tell a high-quality FVG from a low-quality trap.
So that's the million-dollar question, isn't it? Why does price so perfectly respect one gap only to completely ignore the next one? Look, it's not random. It's not a coin flip. The answer is all about understanding the intention behind that gap in the first place. And that's the real key to separating the A-plus setups from all the noise. You see, the answer lies in seeing the market a little differently. These gaps aren't just empty spaces on a chart. They're literally the footprints left behind by smart money. Think of it this way. When huge institutions make a massive move, they do it so aggressively that they leave behind these little pockets of inefficiency. These gaps are the breadcrumbs, and our job is to learn how to follow them.
All right, so before we get to the advanced stuff, we've got to make sure we've got the foundation solid. So let's start with the absolute basics. What exactly is a fair value gap? And more importantly, what story is it telling us about what's happening in the market?
Okay, at its very core, a fair value gap is just a simple three-candle pattern. But it's a pattern that basically screams imbalance. It happens when buyers or sellers push the market so hard, so fast, that it leaves a void. And you know, the market really doesn't like a vacuum. It has this natural tendency to want to revisit these inefficient price areas to fill the gap, which for us creates a major point of interest. And they really only come in two flavors. On the left, you've got your bullish FVG. See that little space between the high of the first candle and the low of the third one? That's a huge sign of aggressive, powerful buying. And on the right, you guessed it, it's the total opposite, a bearish FVG. That's the gap between the first candle's low and the third candle's high. That's our clue that sellers are in absolute control. In both cases, that middle candle's imbalance, that's the sweet spot.
Okay, now this is where most traders stop. They see an FVG, they get excited, and they jump right in. But this is where we get our edge, because just finding a gap isn't nearly enough. We have to filter for quality. And the single most powerful filter you can use is understanding where on the chart that FVG shows up.
And this is just so important to understand. Not all FVGs are created equal. Far from it. An FVG that shows up in the middle of some choppy, messy price action, that's probably just noise. But an FVG that forms in a very specific optimal zone after a powerful move, now that is a high probability signal. Our entire goal here is to learn how to filter out all that junk and focus only on the gaps that truly matter.
And luckily, finding these zones is a super simple, totally repeatable process. First, you just identify the last major price swing, from a clear swing low to a clear swing high, then grab your Fibonacci tool and just draw it from that low to that high. The 50% line is our key. We call it equilibrium or fair value. Now here's the magic. The entire area above that 50% line is our premium zone. That's where price is expensive. And the area below the 50% line is our discount zone. That's where we find the bargains. And this simple concept, right here, this is the golden rule that will immediately level up your trading. I mean, think about it. Just like shopping, you want to buy stuff when it's on sale, right? At a discount. Same thing in trading. We only look for buying opportunities down in that discount zone. And you want to sell things for more than they're worth at a premium. So we only look to sell up in the premium zone. Following this one rule helps keep you from becoming someone else's exit liquidity and really starts to stack the odds in your favor.
Okay, so we have our building blocks. We know what an FVG is, and we know how to find the absolute best locations for them. Now, let's put it all together into a complete, powerful trading blueprint. We're going to call this the FVG in FVG strategy, and it uses two different time frames to give us both the big picture context and a sniper-like entry.
The plan is actually pretty simple and elegant. We use a higher time frame, say the 4-hour or the 1-hour chart, as our strategic map. This is where we do our analysis to figure out where we want to do business. Then, once price gets to our chosen spot, we zoom way in, down to the lower time frame, like the 15-minute or 5-minute, for our tactical execution. This is how we find the exact moment to enter the trade.
So, on our higher time frame map, we've got a checklist. First up, what's the market's overall direction? We're looking for a clear break of structure, a new higher high in an uptrend, or a new lower low in a downtrend. Second, has the market recently swept liquidity? Meaning, did it just take out an old high or low to grab all those orders sitting there? And finally, we mark out our high-quality FVG, one that sits nicely in a discount zone if we're looking to buy, or a premium zone if we're looking to sell. That FVG becomes our point of interest.
All right, now for the fun part, the execution. Once price finally enters our zone on the high time frame, we switch our focus to the lower time frame, and we wait. We don't just blindly hit the buy or sell button. We need to see confirmation that the momentum is actually shifting in our favor. This could be another quick liquidity sweep, or what we call a change of character, which is just a break of the most recent little trend. The second we see that confirmation, we look for a brand new, fresh FVG to form on this lower time frame. That is our entry signal.
Look, having a great theory is one thing, but execution, that's where trades are won and lost. So let's talk about a couple of really common scenarios you're going to face on a live chart, and more importantly, how to manage your risk when you see them.
Okay, this solves two massive problems that every single trader runs into. First, what do you do if your entry FVG is huge? A stop loss below that would kill your risk to reward. The solution is simple. Don't enter right at the top of the gap. Place a limit order at the 50% level of the FVG instead. This cuts your risk in half. And the opposite problem. What if the FVG is tiny? A super tight stop is just asking to get stopped out by random noise. In that case, give yourself some breathing room. Place your stop below a more protected, obvious swing low, even if it widens it a bit. It's about being smart, not just mechanical.
So we've covered the whole mechanical strategy, from A to Z. But I'm going to let you in on a little secret. The real key to long-term success in this game. It's not this specific entry signal. It's not any signal, really. It's all about what's going on between your ears. It's about having a process and having the discipline to actually follow it.
And it really all boils down to these three pillars. First, you have to define your rules. Have a crystal clear plan, just like the one we've laid out. Know exactly what you're looking for before the market even opens. Second, you have to follow your plan. Execute it like a robot, without letting fear or greed cause you to second-guess yourself. And third, and this is the most important one, you have to manage your risk on every single trade. Protecting your capital is always job number one.
And this is something you really have to burn into your brain. A losing trade does not mean you did something wrong. If you followed your rules and took a valid setup, then the outcome is totally irrelevant. Losses are just the cost of doing business in a game of probabilities. Your job isn't to be right all the time. Your job is to execute your plan flawlessly every single time.
By focusing on these high-quality, fair value gaps in the right locations, you really can stack the odds in your favor. But it always comes back to discipline. So I'll leave you with this to chew on. We can spend years learning 1,000 different strategies, but is it possible that a trader's most valuable skill, the one true edge we have, isn't found on any chart, but in our simple ability to just follow our own rules?